So here's the first video of 3, and it's about financial cycles and bubbles. But first, we've been talking in these online learning materials about conjuncture, and I think really I need to make a point about the current conjuncture, which is very much focused upon monetary policy, which we'll touch upon in another video materials, and interest rates, central bank activity. And I think what's interesting and what needs to be considered in terms of our conjuncture now is the extraordinarily low interest rates. This the interest rates of the Fed. Sorry, it's not Fed, Bank of England. And this is the interest rate of the Bank of England. So as you can see, it's at a historic low. We've never experienced interest rates as low as this in this country since the formation of the Bank of England in 1694. And low interest rates have been replicated across the globe to the extent that, first of all, let's qualify what we mean by interest rates. I'm talking about bank rate or Fed rate or the discount rate, or the central bank rate, basically. And these rates have been replicated across the globe to the extent that in certain countries, and I think this is true in the ECB now, the European Central Bank, is that bank rates are negative, which is interesting. But what you do have as a consequence of these low interest rates is that therefore the activities that respond to the conjuncture, the bricolage it's referred to. I'm going to interrupt myself there because I need to say something about the conjuncture and the bricolage that is occurring as a consequence of very, very low interest rates. And this goes back to points that we made earlier on in other materials relating to shareholder value, investors seeking yields, and the size and the power of the financial markets, is that interest rates have created opportunities for banks, intermediaries, and other investors to make quite considerable amounts of money, but they may not, or from the outside perspective, is that they look kind of weird, perverse perhaps, but internally, if you look at the rationale behind it, the conjuncture behind it, it's obvious and self-explanatory as a consequence. But enough of that now. Let's move on to financial cycles. Now, you will have heard of business cycles because of business growth theory and so on and so forth, but have you heard of financial cycles? Possibly not. And this is a statement from the Bank of International Settlements Report 2014. Now, who are the Bank of International Settlements? The Bank of International Settlements are the informal or the unofficial regulator of central banks. They're kind of like a lobbying body for central banks, if you like. It's an extraordinarily detailed website in terms of production of working papers, theoretical papers, practical papers, and has got a massive database of information relating to all the central banks who've signed up to the Bank of International Settlements. It's not the, it has no real official capacity, but as a industry body, it's quite informative and quite powerful. So in this report in 2014 is that the Bank of International Settlements introduced the concept of financial cycles, which we would say, well, that's a tacit acknowledgement of financialization processes, because you've got this bifurcation between the business cycle and a financial cycle. Now, in normal circumstances, or in theory, normal theory is that the financial cycle, where agents are acting as intermediaries, would be in line with the financial cycle. The business cycle and financial cycle would be totally congruent. But what happens when that's not the case, or indeed
what is the case. But before we look at that, as I'm going to show you a financial cycle graphically in a minute, let's consider how they define financial cycles. Okay, so financial cycles differ from business cycles. They encapsulate self-reinforcing interactions between perceptions of value and risk. Risk-taking and financial constraints which translate into financial booms and busts. Now, here's a question for you. What on earth is a self-reinforcing interaction? And you'll understand what perceptions of risk are. And that would mean that people have got different perceptions of the risk. We might be using the same calculations, but as we've said before, the calculations they're a heuristic, they're a guide, they're a learning aid, they're not everything. And when you look at accounts of traders and investors, is that they don't rely exclusively on the calculations. There's more to it than that. If you're interested, is that you could read George Soros's accounts of his time as a trader when he's introduced the concepts of reflexivity in financial markets. And it's very different to the way that the textbooks, which are ultra rational, calculative, probability based, and calculations of risk and so on and so forth. I mean, the practice of it is not the same. So I think we understand what perceptions of risk are, but and then it's this concept of self-reinforcing interactions that's interesting to me. What exactly might that be? Well, I think that what they're referring to here, although they're not using the same words as, they're actually referring to the kind of narratives and stories that we tell each other and ourselves, which underpin and inform the notions of risk and value. So here we have the lobby regulator of central banks admitting, albeit not explicitly, or at least acknowledging, I would say, this concept of financial cycles being driven by narratives and stories and individual perceptions of risk. And what they're saying here as well is that financial cycles tend to be much longer than business cycles and are best measured by a combination of credit aggregates, the amount of credit in the system, which we talked about at length already, and property prices. Property prices, I think, is probably I have an issue with that, in that I think if you're looking at property prices, is that possibly you might be double counting things, because credit aggregates might already include mortgages, and I'm not quite sure what property prices add to the picture. But nevertheless, is that there is a huge statistical model that sits behind this, and who am I to argue with their methodology? And what they do say is it's the interaction between debt and asset prices and output that explains many advanced economies' poor growth in recent years. And that will be the subject of next week's online learning materials. So here's a business cycle alongside a financial cycle. Financial cycle is the blue one, and the business cycle is the red one. And one of the things that you'll notice is that the financial cycle, it looks like somebody's grabbed hold of the curve at the far right-hand side there and just given it a little tug. It's flattened out. And then the other thing that you'll notice is that the blue cycle, the financial cycle, has grown considerably in size and amplitude of the curve. So what this is indicating, is it not, is that financialization has dramatically increased, which we saw in the figures that we looked at when we discussed financialization in last week's materials. Now, we'll come back to this because I think it's a good illustration of a theory that I'm going to talk about later on, which is Minsky's instability hypothesis. But I'm going to park this now, and then we're going to move on and talk about the conjuncture as a global financial crisis. Firstly, is that what we need to understand, and I'm referring as well back to the Lexicon of Finance that I produced earlier on as well for you. We're talking about reinvention of investment banking, and we need to understand the growth of derivatives, the rise of securitization, is that we need to look at how the investment banks invented themselves as well. So Traditionally, investment banks provide services, mergers and acquisition advice, underwriting new issues of shares. They were traditional intermediaries. However, that changed with, again, a rolling back of regulation. Is that regulation from the 1930s had stopped investment bankers working alongside high street bankers and had really imposed upon them this intermediary model. However, more latterly is that investment banks become financial engineers and proprietary traders on their own account. So this means that instead of working for clients, is that they're now working to generate their own profits by trading on their own accounts. And they are borrowing huge amounts of money in order to be able to do that. So if they are investing $1 billion, probably a bit more, but let's say they're investing 10 million in something, they would borrow 50 to 60 million in order to be able to leverage their trades in order to be able to make more money. And also, alongside their high street counterparts, they become mass marketeers of financial services and assets, and they become very sophisticated and very good at doing it. New conglomerates like Deutsche, Barclays, Citibank did both the mass marketing and the proprietary trading. Okay, so you've got huge financial conglomerates working to a greater extent in their own interests. Now, banks are shareholder-driven banks as well. So, banks are under pressure from shareholders, agency problem, to return value back to their investors, back to their shareholders. They're kind of like the double whammy, really. But that's an important part of the conjuncture. And then the next bit is the securitization. And this is linked to the idea of the originate to distribute banking model. Okay. Key idea here is that you raise funds from outside investors, which releases liquidity. So it's the issuances of marketable securities backed by cash flows from specific assets. And you've got different parties that are involved in it, which makes the structure of the securitization less than transparent. It's difficult to see what's going on and where the money's flowing. You'll see on there's an SPV, which is a special purpose vehicle. These are off-balance sheet entities. So they are independent but wholly owned companies of the bank that are designed to do the work of the securitization, so that a lot of the figures that go through the SPV don't find themselves on the bank's balance sheets. And on top of that as well is that the credit rating agencies are involved as well in terms of rating the securitized assets. Unsurprisingly, you get huge growth in securitization, and particularly with growth to the mortgage market, in that much of the commercial lending of banks is in mortgages. Mortgages are very important to banks because they are big loans, but also is that the people that take the loans out work jolly hard to pay them back. So they're considered to be relatively secure and good investments and very profitable. And just to underpin the point, you can see leading up to the crisis in 2007, how the growth in securitized issues goes up from 685 billion in 1996 to 3.1 trillion in 2006, and that's replicated all over the place as well. It's worth pointing out is that the notion of the securitized notes that are being created is not just a uniquely American phenomenon. It was a global phenomenon.
I'm going to interrupt myself again there, because I've used the word global. That's not strictly correct, is it? Given the examples that I've provided for you. Is that, broadly speaking, securitization was a phenomenon in those areas where there were very large and very sophisticated financial sectors.
I think what's interesting here is that in November 2008, after the collapse of Lehman Brothers, is that Her Majesty the Queen opened up a new part of London School of Economics it was. And she asked at that function, she asked the assembled glitterati of economists, why did nobody notice it? Why didn't you see it coming? And the reason that she did that is that prior to the collapse in itself, is that there were many statements made by political leaders and economists as to say that, yes, there might be some overheating in the housing market, but it's insubstantial. There'll be a price correction and it'll be fine. Gordon Brown, the Chancellor of the Exchequer of the Labour government at the time, claimed that the Labour government had conquered boom and bust. There was a period of what's known as the great complacence or the great moderation, in that business and finance grew, albeit unspectacularly, but it looked incredibly stable and looked like it was going to go on for a considerable while. And when it did blow up in the way that it blew up, it was a genuine shock to political leaders and economists. Not all economists, I think it's worth pointing out, because there were a number that had been making claims from 2005 onwards, Steve Keen being one of them, Nouriel Roubini being another one, making claims that there was quite a considerable amount of pressure in the economy. And I think that what this underpins is that if what you're doing is that you're being driven by a model to look at certain things, then you're missing others, which could be important, because your model, your framework says that you don't need to look at those. So in the case of central banks, the banking industry, that are using what's known as, and I'll get these the wrong way around probably, but dynamic, stochastic, general equilibrium models. In other words, models that says that things tend towards equilibrium. Well, the great moderation, the great complacence seemed to be proving the point that actually the economy was tending towards equilibrium. However, we've still got a global financial crisis. So in the materials, I refer to Minsky's quote, and I think that this underpins Minsky's quote, is that if your frames, what you're looking for, tell you something, it kind of like indicates you what you should be looking for. And therefore, what you might well have a tendency to do is to use the data to prove your point. If the banking industry had been referring more closely to Minsky's model, then maybe we might, that more corrective action might have been taken, which could have offset the global financial crisis. The frameworks were there in order to be able to understand the global financial crisis. But because they were not considered to be mainstream, because they were not considered to be part of the orthodoxy, is that by and large they were generally ignored.
I don't want to labour the point, but I'm going to, is that if what we're doing is that we are looking for evidence to prove our own point, to prove that we're correct in the first place, that's not science. We as social scientists, is that we must look at compiling and a contrasting argument, and then looking at the evidence in support of those sides, and then making a conclusion based upon the evidence itself. Now, if there'd have been a more critical looking at the data and the data sets that were apparent at the time, and as I said earlier, perhaps the worst excesses of the financial crisis could have been offset. And with that, I'll leave you with that thought.